The problem of repressing the asset markets too much is that you caused massive distortion. So the Fed has understandably wanted interest rates to be very low. Now, if you're an investor, government bonds are your safe asset. Government bonds is how you diversify away from equity. But if the price of government bonds is artificial as it is today, it's too high, this is no longer a risk mitigator for you. So you look elsewhere. Normally you would look to gold, but there are issues with the gold market. So a lot more people have gone into Bitcoins as their risk mitigator, which sounds absurd because Bitcoins are incredibly volatile. But this is a situation where it is, in the eyes of some investors, the least bad asset to use. And that's just an indication of the distortions we're having in the marketplace because of this massive intervention of central banks.
What is it in your eyes, Mohammed? Is it an appropriate investment approach? As you said, it's the least bad option in a battle of the uglies, it seems. Is this an appropriate investment choice to be making at this moment when you have no other choices?
So if you're making it, it's because you believe that private sector adoption is going to continue, which I think is the right thing to believe. But also you believe that governments are not going to interfere with this. That I'm not too sure about. So I tend to tell people, be really careful. This is an asset that wants to establish itself, but it can only establish itself if governments allow it to. And it takes away a lot from governments. It takes away what is called seigniorage, the ability to provide currency and benefit from that. So I tell people, be cautious, because not only are you assuming on private sector adoption, but you're also assuming on government tolerance. And that second one, I'm not so sure about.
I was having the debate last week that whether or not Bitcoin is too big to fail, and whether or not it is, governments could still step in and say to regulated companies in particular, we want you to stay away from this. Your view on both of those things, too big to fail and the likelihood of regulators saying, I'm sorry, we don't want you involved in this, it's still too risky at this stage?
So from a narrow perspective, it's not too big to fail. From a broader perspective, that would be another challenge to the liquidity paradigm, where investors simply bet on liquidity. And as I said earlier, we've already had 3 near accidents, so you've got to be careful. You never know which little fender bender is going to cause a pileup on the highway. And that's what you've got to be careful about.
You know, one of the other things that people are pointing out at this stage, and crypto enthusiasts, but it also ties to the point we were making about the jobs numbers not being so inflationary, and that was the wage component, is the money supply growth that we're seeing, record money supply growth. And I'm looking specifically at what we call M2, increasing 27% year on year in the February numbers. It was almost as high in the previous month. Mohammed, when this is used as an excuse or a reason for investing in cryptocurrencies, what do you make of it, and how should we as ordinary investors or ordinary individuals be looking at specifically that number as justification?
So remember, you have 3 types of investors in cryptocurrency. You have those who do it for defensive reasons, and we talked about that. You have those who do it for speculative reasons. But also you have those who truly believe that we are debasing currencies because of money supply growth. So they're doing it for a positive reason. They're embracing something that cannot be debased. So the more money supply growth you're going to see, the more that's going to push people into the currency. The problem with the money supply growth is that it made sense when the U.S. economy was facing headwinds. Now the U.S. economy has massive tailwinds, and yet we continue to grow the money supply at these incredible levels. And that's why people are starting to say, hey, wait a minute, shouldn't the Fed be slowly taking its foot off the accelerator?